Okay, now I think I make a big mistake, a huge mistake in the NPV. For the cash flow, I should link it here. Okay, so it's a J1I, yes, should be. Okay, so your NPV is still negative. Okay, right now this is, I don't know, this is you have a cash flow available for debt service, EBITDA, you have a corporate income tax, EBITDA 104. EBITDA is this one 104, 153. Yes, that's your EBITDA. So EBITDA minus corporate income tax. So this is after tax, and then you have interest expense and debt principal repayment, and you have the how about if I use this so instead of a total debt, I will use EBIT divided by total debt service. Okay, so I will have this cash flow coverage ratio. This you have the EBIT taking from the profit and loss, EBIT, and then you have debt service, and then you have the ratio. If arrow, then is divided by this, otherwise you have 0. Okay, right now you have the just okay, and then I think this is just cop, I don't know, just put from here. So I just, is this format painter? Yes, I think it's a format painter. Okay, so you have not too bad, I think, in terms of the payment of the interest and debt. You still can make it. Okay, now we have to go to, this is for the equity. So let me see. So the project is not really good, yeah, I don't know, I think probably for the equity also not really good. So this is like a NPV to the equity holder. Okay, I think we just have to put cash flow available distributable to equity. Equity, I don't know, just have to take from this. Yep, yep, but you still have let me see, I think because the investment is okay, now you have the, this is not correct because you have the cash flow, but you have to invest, so EBITDA less corporate income tax. Okay, I will use from here. So I just link it, and then you have the initial investment by equity. So I just have to put here, I think, USD, and then you link it to assumption. Okay, 140 million, and then you have a multiplier I don't know, I will put multiplier here. Oh, you can link it. I don't know, just put a multiplier here. You have 1 million here, multiplier. So multiplier, then you have a total initial investment, full initial investment, equity investment. Okay, so this will be blue, italic, and then this is basically you just times this. Okay, this is the calculation. I don't know whether we have this. No, we don't have that, so I just okay, now you have here, and then I just link it. So this is -1, I put red, and then you just times this one, and then you just have to times the initial investment. Okay, and then you just have 20. I think you have to fix it, function f4, and then you have here function f4, then just copy it to the right. I don't know, let me see. Okay, and then you have the net cash flow, net cash flow to the equity. This is after tax. This after tax. Okay, and then you just have to this one plus this one. I don't know, I just have to okay, and then you just copy it, and then once you have that, I just have to save it, and then let me see, you have NPV of the equity, NPV to the equity. Okay, I will use the discount rate first. So you have equity discount rate. So this is percentage, and I'll show you. And then I just link it to the assumption. Okay, put the blue one. Okay, so NPV of the equity, I just have to put more space here, just save it. Is equal to NPV, then you have your rate, and then you have your value, then you close, and then you plus your initial investment. Okay, still positive. Interesting. Put yellow ball, so still positive. It's very strange, yeah? Because your equity NPV is negative, but your NPV to equity is positive. Okay, I'll check the ERR to the equity. Just put ERR. So it's 31%. Not too bad. So NPV of the project is positive and this is the negative. It's very interesting. I think there's something wrong here. I'm going to discuss that in another video. So if you find that the NPV of the project is positive, equity of the project is negative. So the situation we have here, NPV of the project is negative, but the NPV of the equity, NPV to the equity, NPV of the equity is positive. So this is raising the red flag. Okay, I'm going to check that in another video. What is the what's the problem with this? I guess there's something wrong with the, I don't know, I have to check first. I think this is a bit we have debt. This is debt repayment. Okay, less sinking fund reserve. Okay, there's something not right with the discount rate. Okay, I'll come back with that. There's a raising red flag. Okay, I'll put in the red because I promise I come back with you with this problem. It's football. Okay, thanks for watching the video.